Did you know that the Terra team was actually really quite serious about testing their stability protocol? They put in quite a lot of effort to try to understand in advance whether the peg would break. So when this happened, this was contrary to their expectations, and they had actually done quite in-depth testing. This is a paper that they produced back in April 2019, where they very carefully thought through how to test their stability protocol. They found ways of subjecting a simulated version of the protocol to a bunch of different types of circumstances, and did quite a lot of computation to test this. The conclusion that this paper reached, I'll read it to you here. They said, "We use the above components to subject Terra's stability mechanism to a broad spectrum of market conditions, applying two forms of stress, cyclicality, macro, and volatility, micro. Our findings, based on 100 different stress settings and 1 million years worth of simulations, indicate that Terra has high resilience to both forms of stress." Now, you might think that, sure, this paper was just produced in order to convince VCs to invest in the Terra project. But that's not true. How do I know that? Because I was in conversation with Djed back at this time. We had a pretty collaborative relationship, even from the beginning, even before our projects launched. So here you can see Djed saying to me in May 2019, "Would you be interested in taking a look at our stability research and providing feedback? We're flexible on publication format, can be negative and publicly posted. Just want to get a lot of feedback on our parameters. And our research team can do the same for the reserve protocol if interested." So the reason I have this document is because Djed sent it to me and asked for our critical feedback, even invited us to post negative feedback publicly if that was the conclusion we came to. So I really do think that Djed and the rest of the team were seriously evaluating the protocol and trying to understand if it was going to work. They were not just running into this without thinking about it at all. And yet, I predicted, I should say, I never read this paper. I never read the paper. And the reason why I never read the paper is because we had already tried to do simulations ourselves and realized, we came to the conclusion that if you're trying to run market simulations on a stablecoin protocol, it's a bad idea, because any simulation, you're going to have to basically program in your assumptions about how markets are going to behave. And so you're just finding out if the stablecoin protocol works under your assumptions about how markets will behave. And in this case, it did. They found that there was a high likelihood under those assumptions. This was a slightly different version of the protocol, but I'm sure they applied the same rigor to the updated protocol. You can see, obviously, everyone has seen this play out in the past few days, that market conditions were encountered and market behavior was different from whatever the team thought could play out. And even though I never read this paper, I was able to predict back in 2019 that the Terra protocol had a high likelihood of crashing, and I was very concerned about this. This was captured on video at the BitConf in December 2019. This video was posted in May 2020, and just recently, because of the crash, it's been viewed 250,000 times. In case you haven't seen it, I'll play it for you now. I think that the biggest risk, the thing that could go really massively awry with stablecoins that could be terrible for the crypto world overall, is if there's an algorithmic stablecoin that has no backing, that just has a sort of algorithmic mechanism that's meant to keep it stable, which we tried really hard to figure out one that would work in it.
Stable relative to?
Whatever their oracles are pinging the price of. It could be the dollar, or the euro, or gold, or what have you. But there's a category called algorithmic stablecoins. I would put Terra and Celo in this category. There are a number of others. Basis was like this, and they never launched. The thing that could happen is one of those could launch and be marketed very effectively and be significantly adopted. It could even happen in a market where people really, really need a stable currency and don't have one, and that's why it gets massively adopted. People who are not crypto speculators, people who just want to preserve their savings.
If that protocol then blows up economically and falls apart, and the price of that goes, down half or close to zero, regulatory backlash. Imagine if we were sitting here today talking about how great our stablecoins were, where it had already been the case that like $1 billion stablecoin had collapsed and lots of innocent people had lost their money. It would be a very different situation. And that really could happen. There are economic experiments being run with some stablecoins that I believe personally could go that direction. And so I think the worst thing that could happen is if one of those gets really big before it fails.
Yeah, it's like they hard code economic theory into a thing, let it go, and it runs, and then...
And to be clear, NuBits and BitUSD, like BitShares, are both like some form of like algorithmic stablecoins that have collapsed. Like the peg has broken. It's just that it was a tiny number of people in crypto using them, right? But we have these bigger projects who are marketing to huge numbers of normal consumers. And so I think there's a real risk, a real thing to be worried about there.
I believe there is no way to launch uncollateralized algorithmic stablecoin.
It's happening. It's already happened.
Yes, but there is no way to get adoption. Why people will use that?
Terra will tell you that like hundreds of thousands of people in Korea are using it to like pay for like the most popular thing is diapers on an e-commerce website because they have like partnerships with people and they're offering massive discounts.
And make a diet, people are using
like
it.
Ponzi schemes.
I don't want to use that term. I don't want to use that term. But so, basically paying for adoption is something that could cause this.
Okay.
And unfortunately, exactly this is what has just played out. So you can see here the price of LUNA completely crashing in anticipation of massive hyper dilution of LUNA, which did play out as expected. So you might wonder, how is it predictable? How can you know in advance when this is going to happen or is not going to happen? Well, our team looked at past situations. So like I mentioned in that video, there were past examples of stablecoins breaking their peg earlier on in crypto. But the way that we came to these conclusions is by doing very deep thought. So here's like a 22-minute post from 2018 where we really just walk through all of our reasoning for how this particular kind of stablecoin, this is similar to the Terra design, will behave, and really pick it apart. And you can go read this post if you like. We outline a lot of detail about how this sort of thing unwinds. It's not that we were just concerned on a high level. You can think about the mechanisms and understand it. And you might think, well, is Nevin and are the reserve team just, trying to make other projects look bad? Well, I hope I can convince you that's not the case, because we did an analysis of the Maker protocol also in 2018, and we predicted, even back at the time, that it would stay relatively stable. And that it would put stablecoin users at little risk. This is the complete opposite prediction that we made about the Basis protocol, which is very similar to the Terra protocol. And just for historical context, the Basis protocol was based on an idea called senior shares, which was published originally back in 2014 in this short paper. That's about as short as the Bitcoin white paper, and outlines the basic idea. That's led to many different types of algorithmic stablecoins. So I want to talk about 3 types of stablecoins, how they're different, how you can tell the difference, and choose stablecoins that are safe, and how, as an exchange or wallet operator, you can facilitate your users choosing stablecoins that are safe, even if lots of individual users won't understand things on this level of detail. Okay, so first off, we have stablecoins that are 100% backed with stable assets. Okay, so the classic US dollar backed stablecoins like USDC, TrueUSD, Paxos, Binance USD, USDT are like this, right? So the simple design, right, is you have dollars in a bank account somewhere, or assets that are very, very stable against the dollar, like US Treasuries, And with that type of stablecoin, everyone can redeem their coins for dollars if they want to, basically, as long as the issuer actually has the money that they claim they have, or the highly stable assets that they claim they have. And those are generally very safe, unless the issuer is substantially misbehaving. That's something that it does make sense to worry about a little bit, but generally speaking, it's a very different ballgame. The second category starts to get a little bit harder to understand, and it's stablecoins that are more than 100% backed, like over-collateralized, but with volatile assets, with a different asset than what they're pegging to, right? So if you're pegging a coin to the US dollar, as stablecoins typically are in this day and age, then you have to worry about whether your backing will depreciate relative to the US dollar. And so these over-collateralized stablecoins, that makers DAI is the main example. They often have 200 or 300% collateralization, but that collateral is something that is volatile. For example, ETH or other cryptocurrencies. And I'll go into it in detail in a minute, but that design, if it's executed well, if it's parameterized well, can actually be relatively safe, as we predicted in that analysis back in 2018, even before DAI had become popular. If you think it through, you can tell that actually there's a way to make this work. And it's still vulnerable to really extreme flash crashes in the value of that collateral, but it's something that actually can be done relatively safely. The third type is what people typically call algorithmic stablecoins, and that's what Terra's UST was. And algorithmic stablecoins, there are different variations. There's different ways that people have tried to implement them, but most of them tend to be based on the same basic senior shares idea. And I'll describe that idea in a lot of detail to you in this video so that you can understand how it actually works. And algorithmic stablecoins generally are quite risky. It's generally not a good idea to try to make an algorithmic stablecoin and promote it to a broad audience. That's something that can hurt a lot of people, as we've just seen. And unfortunately, it wasn't easy to convince people of this before it happened on a large scale. There have actually been, even since that video in 2019, there have been a few different cases of algorithmic stablecoins with this design falling apart. There was the Iron and Titan example and Basis Cash. Honestly, I don't think I did enough to try to convince people of this issue. Yes, we did good analysis. Yes, we made predictions. Yes, we talked to people about it. But at the end of the day, there was sort of a lot of doubting of that analysis and a lot of sort of shouting at us to be more friendly. Actually, when we were raising our seed round, I think it's fine to share this. Andreessen Horowitz was going to invest in Reserve Seed Round, and they were also an investor in Basis. And then we published our analysis of the Basis protocol, and they got back to us and they told us that they were going to pass. And the specific reason was because of the fact that we published that analysis. And they said they didn't like the tone of the analysis, and they felt that the space needed to be more open and collaborative than that. Which, I kind of get that. They were invested in a competitor. That alone is maybe a fine reason to pass. But I think that the space needs to be honest and critical if we're creating something that can get big and hurt so many people, as we've just seen. So I really actually think that I disagree with that statement, and I regret not doing more. And I think that the industry overall was complicit in letting this happen, and we need to figure out how to do better going forward. And I'll share some thoughts about how to do better going forward at the end of this video. So now I'm going to talk about these three kinds of stablecoins in more depth. Let's start with algorithmic stablecoins, because I think it's the thing that everyone is most trying to understand right now. It's like, okay, UST fell apart. This was really bad. How do we prevent this? How do we recognize this? what actually happened. Why did it happen? So going back to the beginning idea, that idea that was published in 2014 of senior as shares, I'll even use the terminology from that paper. The original idea is, kind of starting from Bitcoin. It's like, how do we have something like Bitcoin that's stable? And so the first idea is, okay, instead of just having one token, you have two. Instead of one token, kind of like Bitcoin, you have two. Let's call one the coin and the other the share. That's what that paper called them. And that's equivalent to UST and LUNA. The way that this process works is that let's assume that the coin starts off trading at $1, and then the protocol is just trying to maintain that price. Now, if the coin goes up above $1, then the protocol can mint new coins and allow market participants to purchase them for $1 worth of shares, okay? And so that means you can go take, $1 worth of share tokens, you can trade them in and get one coin, and now you can go sell that one coin for, say, $1.05, if that's what is trading on the market. So you immediately turn $1 into $1.05, and you get 5 cents of free profit in an active arbitrage. And that incentive, you can just trust the market's going to do that. Who doesn't want free profit? And so when you sell that new coin into circulation, you drive the price down a little bit when you're market selling. Everyone in crypto is familiar with the dynamics of the more people buy, the more prices go up, the more people sell, the more it pushes prices down. So arbitrages will continue doing that until the price is pressed down to $1. And so you've added coins to circulation, you've driven that price down. The flip side is if the coin, let's say the coin goes down because demand has gone down and is trading at 95 cents. In that case, the way the protocol works is it mints new share tokens. And it sells, let me make sure I get this right. Essentially, yeah, so anyone can come and redeem their coins for $1 worth of share tokens, okay? And so what that means is you can go buy a coin off the market for 95 cents and then go bring it back and return it to the protocol and get $1 worth of share tokens, which you can then go sell elsewhere in the market for $1. So you've turned 95 cents into $1. Similarly, you got 5 cents for free. And who doesn't like free money? So you can pretty much rely on the market doing this. And so again, in order to do that, you had to go buy the coin off the market for 95 cents. So you've driven the price up a little bit on the market when you make that purchase. And if you keep doing that over and over again, you're buying of coins, you'll bring the coin price back up to $1. And all the protocol had to do was mint shares in order to offer $1 worth of shares for every coin. And because the protocol is in control of the number of coins and the number of shares, there's no limit to those. It can mint as many coins and as many shares as it wants. So as long as it can always mint $1 worth of shares, it can always buy back one coin for $1. And so that's kind of where the name algorithmic comes from. It's because there's just this algorithm in the background that's responding to market conditions, that's offering these trades, and the algorithm has total control over the number of coins and the number of shares. And so it's able to, in theory at least, it's able to always return the price of that coin to $1. That's the basic idea. And that idea led to Basis, was kind of a derivative of that idea, sort of one complexification. The original Terra protocol was like another complexification of that idea. And actually Terra, if I understand correctly, sort of became closer to the original idea there. So obviously we've just seen this fail. So now everyone's convinced that this fails. Now that we all know that this can fail in a really big way, that's really painful, let's talk about how it fails and why it fails. So the protocol, again, it can always bring the price back up to $1 as long as it can mint and sell $1 worth of shares per coin that it needs to buy out of circulation, okay? So that means that if there's infinite demand for shares, if there are always market participants that are excited to buy shares on the market, then this protocol would just work, right? It would be sort of magic in that sense, because there would be no limit to how many coins it could buy out of circulation. So even if there were, 15 billion coins, roughly, like there just were, the protocol would easily be able to buy back $15 billion worth, because it would just keep printing shares and selling them for coins. The problem, of course, is that there can sometimes occur circumstances where the market no longer wants to buy those share tokens. And if the market no longer wants to buy those share tokens, then the protocol has no way of buying back coins. So if the coin is trading at, say, 95 cents, and that means that everyone in the market, is only willing to buy them for 95 cents, and the protocol, has no way to buy them because the shares have no value. So it can't offer $1 worth of shares because the shares aren't worth anything. And we can see this happening right now, right? So if you look at the current market conditions, let's just look at them. If we look at the current market conditions, the share price has gone from $90 or whatever it was to almost zero, right? It's very, very, very low. And the protocol has minted, trillions of shares, but they're just worth almost nothing. And so it really just doesn't have the power to buy these coins out of circulation. If these Terra UST tokens could be bought for $1 by the protocol, then people wouldn't be trading them for this low price. It would be very exciting to go buy at this low price and redeem for $1. But the protocol has completely lost its ability to do that. So why did it lose its ability to do that? Why did people stop valuing LUNA, the share token? Well, the share token gets its value from, in this case, expected growth, right? So let's look at the economics of the share token. Why do people want to hold the share token? Why does it have value in the first place? Well, it has value because when demand for the stablecoin is growing and new stablecoins are getting minted and added to circulation, those new stablecoins, when they're added to circulation, remember they're being sold for shares, and those shares are burned. And so that's basically equivalent to the protocol market buying shares off the market and deleting them or burning them, okay? And so that provides buy pressure on the share token, and in theory, and as we've seen with LUNA, in practice, it drives up the price. And so it can be exciting for speculators to hold that share token because they can see that, if more and more people use the stablecoin, more and more share tokens are going to be bought and burned off the market. That'll drive up the price of the share token. As soon as you get to a point where the demand is even just steady for the stablecoin in the senior shares design, well, no more shares will be bought and burned, right? Like if you imagine the number of stablecoins will stay the same at 15 billion or whatever forever, well, now the share token doesn't exactly have value because there isn't anything that's going to, nothing's going to buy it, and so it's just a token at that point. And people might start to wonder, well, okay, so why are we holding this token? It's just a token. It doesn't do anything. And if they anticipated that there would be a lot of growth in the future, even if it's years from now, you still might want to hold that token because you can tell that buying and burning will happen in the future. But if you anticipate that no growth is ever going to happen, then there's not necessarily an incentive to hold it. And to be clear, I think with LUNA, there may have been other mechanisms that the team added to try to give LUNA value. So I don't want to step on anyone's toes by saying that there would be no value there. But let's look at the other case, which is where you anticipate demand for the stablecoin going down rather than staying steady or going up. Well, if the stablecoin demand is going to go down, if lots of people are going to be coming and redeeming their stablecoin with the protocol, when stablecoins are redeemed to the protocol has to buy them back with newly minted share tokens. So that effect of buying and burning share tokens to drive the price up actually ends up going in the other direction. You're minting and selling share tokens, and that drives the price down. Okay, so if you're a share token holder, or a LUNA holder in this case, and you can see, oh wow, a lot of people are probably about to redeem their stablecoins, That means tons of share tokens are going to be minted and sold onto the market. What do you want to do? Do you want to hold your shares and see what happens? Maybe, but you probably want to sell your shares first, right? Because you can tell the share price is probably going to be driven down. So as soon as the share token holder population comes to believe that demand for the stablecoin is going to go down in the short term or on average in the long term, it starts to look like a bad idea to hold the share token at all. It's like, okay, we rode this on the way up. Now let's get off the bus because, it might actually just, all of that exciting buying and burning is just going to turn into minting and selling. So it makes rational sense as a share token holder at that point to try to sell your share tokens as fast as possible. Well, you can also tell that other share token holders are probably thinking the same thing, right? If they understand how this works, at least. And so not only are you trying to front run the protocol that's going to end up minting and selling a lot of share tokens, but you start to have to think about how do you front run the other people who are going to sell their share tokens. And so if the market really comes to believe that demand for the stablecoin is going to go down, then you can pretty much expect the value of the share token to massively crash. So if the value of the share token massively crashes, why is that a problem? Like maybe that's fine. Maybe it's okay for there to be dips in the value of the share token. And the answer is like, yeah, a small dip could be okay. But you have to think about what happens if there's a big dip. So let's talk about rough market cap numbers that we just saw with LUNA and UST. And these are not perfect numbers, they're rough, but I think they're close enough and they should help us understand. UST was at about 15 billion in market cap, and pretty recently LUNA was at about 30 billion in market cap, okay? So like 2x. In that situation, there's kind of this sense of like, it's not quite accurate to say that you then have $30 billion of value backing the 15 billion in value. It's kind of true. But that really comes down to the question of, let's say you have 15 billion for the stablecoin and you have 30 billion for the share token. And then $1 billion worth of the stablecoin decides to redeem on a particular day. So it goes from 15 billion down to 14 billion. In that case, you're going to mint and sell $1 billion worth of share tokens to buy back that $1 billion worth of stablecoins. So you had a market cap of 30 billion for the share token, and then you mint and sell 1 billion more in share token. There's a question of, now do you have a market cap of 31 billion? Like if the price stayed exactly the same, you'd have a market cap of 31 billion. Or you might think, well, maybe it's going to just dilute the market cap and drive down the price of LUNA sort of like pro rata, or the share token like pro rata. So you still have a $30 billion market cap, but the price of the token has gone down a little bit from that 1/30th dilution. Or it could be that it's sort of overly reflexive, and actually because of people rushing to sell in front of the protocol, maybe you drive that market cap down and you actually end up with a market cap that's lower than 30 billion. And I don't think that there's no particular economic rule that tells us it's going to be one or the other. This is just a question of how the market behaves. And this goes back to the point about simulations. If you're trying to simulate that, you start having to make assumptions about how that's going to work. And you don't really know. You don't really know how the market's going to treat that. It probably has to do with a whole lot of different factors about people's sentiment, about the liquidity for the share token in the market, and so on. If there's very low liquidity for the share token, then maybe minting and selling $1 billion worth, that might drive the price down by 30% or 40%. If there's an enormous amount of liquidity and people are very bullish that day for some reason, then maybe the market cap actually expands 10 or 20% on that day. You really don't know. But so putting these pieces together, you can start to see that really what's mechanistically backing the stablecoin in this case is the present demand to buy share tokens on the market, right? If there's lots of buy demand on the market at a certain price, at the current price, then the protocol can mint share tokens, buy back coins, and the people who sold the coins back can take those share tokens and go sell them into the market to get their arbitrage profits. And if there's plenty of buyers at that price, then okay, fine. But if that selling of share tokens drives the price of shares and the market cap of shares down significantly, then that can be an issue. And there can even be a situation where, and this is essentially what happened, where lots of people start to rush to redeem, and that essentially exhausts the liquidity for those redemptions. It basically exhausts the liquidity in the marketplace for the stablecoin, and then that can start to cause lots of share tokens to be minted because people are redeeming with the protocol. And then if those share tokens are all dumped very quickly, that can exhaust the liquidity for the share token and start to cause the price of the share token to really tank pretty quickly. And so psychologically, if the share token's sitting there at 30 billion and the stablecoin's at 15 billion, that feels pretty good, right? Like even if you don't think about these mechanisms in detail, which most people don't, it's like, yeah, that seems okay. I'm okay holding that. But now imagine that the stablecoin's at 15 billion or 14 billion and the share token's down at like 9 billion. And you're like, even if all those share tokens were like directly backing the stablecoin, which they're not quite, but even if they were, you can sort of think about it from that perspective, you can tell that it's not fully backed, right? You could have a bank run situation. Let's talk about what a bank run is. A bank run, in the case of a stablecoin or an actual bank, there's actually conflating two things. They're not exactly the same, but I'm just going to abuse the term like everyone else does. With a stablecoin, what we mean by a bank run is, let's say you have a fiat-backed stablecoin, just backed with dollars. You have 15 billion in circulation in the stablecoin, and let's say you only have $10 billion to back it. Okay, well that means if $5 billion worth of stablecoins are redeemed, well, okay, you had 10 billion, now you have $5 billion, so you were able to do those redemptions. Okay, but now you have 5 billion left in dollars and 10 billion left in stablecoins. And so you can see if people keep redeeming their stablecoins for dollars, if they redeem 5 billion more, you get down to 5 billion in stablecoins and $0 left. So those 5 billion in stablecoins at the end of the day have no backing, and thus they have no guaranteed value, right? And so a bank run can happen when the market comes to see, only a fraction of this is going to be redeemable. And so I need to rush, that's the bank run terminology, I need to rush to try to redeem as quickly as possible because I don't want to be at the end of that line. If I'm at the end of that line, then I'm not going to get anything. And so as soon as anyone starts to think about that, again, they can tell other people are going to be thinking about that. Everybody rushes to do it as quickly as possible. And we saw that happen with the UST situation, where once people saw the peg break a little bit, everybody wanted to get out as quickly as possible. So if you can visibly see the market cap of the share token is less than the market cap of the stablecoin, then even with that simplistic understanding of the share token backing the coin, again, even though it's not really true, it starts to become very scary. And you want to redeem as fast as possible. But the more you redeem, the more that prints shares, the more those shares get dumped, the more that tanks the price and market cap of the share token. And as we just saw, this can unwind spectacularly quickly, right? So all it took was something to cause a crisis of confidence, to cause enough people to be concerned about UST, about the stablecoin on a particular day, that they started being willing to sell at a discount. And that caused everyone to see, okay, the peg might be breaking. That caused people who are share token holders, who are LUNA holders, to go sell their shares because they thought, oh man, this could fall apart, I got to get out now. And very quickly, LUNA went from being worth significantly more than UST to being worth notably less than UST. And once that happened, it was pretty much irreversible. The situation maybe could have turned around before then, but at that point, psychologically, it's just too scary. Nobody wants to hold that. And so, pretty much just like you would expect, everything unwound. And so, that's really how the fundamental basic idea that spurred a lot of different algorithmic stablecoins, that's how it works, and that's how it can unwind. And now that we've just seen it, I think we can believe it, right? Before this, there were smaller ones that fell apart. But we kind of were living in a reality distortion field, thinking, well, it's pretty big. There's lots of things propping up demand for it. Maybe it'll work. And that turned out not to be true. So, there are different variations of algorithmic stablecoins, and there are even these days kind of hybrid designs that mix partial, external collateral backing. And those might reduce the risk, but if you don't have 100% backing, it's still risky, in my opinion, and we need to be skeptical of those designs. You can sort of see this in part because, the Terra founders, I think, really, they started to worry about this, and that's why they started accumulating Bitcoin. They wanted to hold assets and other tokens, but mostly Bitcoin. They wanted to hold assets whose value wasn't reflexive to this situation, so that if people started to worry, they would have this extrinsic pool of value where, Bitcoin, at least in theory, wouldn't go down very much in price, whereas Luna, could crash in price. And, in a sense, they were right. Bitcoin actually didn't go down in price nearly as much as Luna, right? Because Bitcoin's value is not just attached to the Terra protocol. It's a totally separate thing. But they didn't have enough, right? If they had $15 billion worth of Bitcoin on that day, then it would have been okay, right? If you had 100% value backing, that's extrinsic, but they only had a fraction. And when you have a fraction, that can help. But again, think about a bank run, right? Even if you have, 75% backing in hard assets that are external to your protocol, people can still see that 25% of holders wouldn't get anything if everyone tried to redeem. And so if you start to see that people are redeeming, of course, you're going to rush to redeem. And so any amount of backing that's less than 100% really can put us in danger of a bank run scenario. And we need to be skeptical of any designs that have that property. They can end up being in a situation where there's significantly less than 100% backing. Now let's talk about the other two types of stablecoins that I mentioned. So, obviously there's directly, stable asset, 100% reserve stablecoins. Stablecoins like USDC or USDT, where you have 100% backing, and the backing is with a stable asset. It's not something that would fluctuate in value relative to what you're pegging to, and it's not something that's attached to the protocol for the stablecoin. So, take USDC. There's dollars or dollar equivalents held by the issuers. The dollar equivalents, maybe they're U.S. Treasuries or other low-risk assets. There's very low probability of those depreciating relative to dollars. And so you don't really have that bank run dynamic, because you can see, again, that even if 100% of holders wanted to redeem over the course of, a short period of time, as long as that issuer can get their assets together and do those redemptions, there's no reason why anyone at the end of the day would be left holding nothing. And that gives people confidence. And so you don't feel the need to redeem in that situation. I think regulation is really useful in the case of stablecoins that are issued off-chain like that with off-chain collateral, because the blockchain doesn't know if those dollars or dollar equivalents are there, or gold or euros or whatever it is that the coin is pegged to. Only humans can really investigate that. And so the process that we've come up with of financial regulators looking at that and stablecoin issuers performing audits, or as close to audits as they can get, and publishing those results, that makes sense, right? We need that in order to trust a fiat currency or gold, etc., an asset-backed stablecoin, a stablecoin backed by assets off-chain. But if you do have that regulation in order to make sure those assets are there, it's a pretty good idea. I think it's economically sensible, and I think the risk to consumers is quite low. Let's talk about the third type, which is a little bit confusing, because it's a little bit more complicated. I mean, it's significantly more complicated than a full reserve stable asset backed coin. And And yet, I still think it can be done in a relatively safe way. And DAI is the main example. So let's look at Maker's DAI. So we won't look at it in detail because it's very complicated, but the basic idea is that you back the stablecoin with assets that are volatile relative to what you're pegging to. Okay, so relative to what you're pegging to, let's say you're pegging to the dollar and you're backing with ETH. It's kind of the simple example. That's how DAI worked at the beginning. Obviously, ETH can go down in value relative to the dollar. So we have to worry about that same situation of like, what if you have 15 billion in the stablecoin and you started with 15 billion in backing, say, but then ETH goes down and now you only have 10 billion or 5 billion. Well, then obviously you would get a bank run in that scenario. So you need to make sure that you don't have less than 100% backing. And the way that you do that, the way that these designs tend to do that, is via over-collateralization. And that just means, if you have 15 billion in the stablecoin, then maybe you have 30 billion worth of backing. And in this case, that 30 billion in value really is directly backing it. It really is that you can redeem the stablecoin for that backing. Maker, this doesn't exactly work quite like that, but it basically does for all intents and purposes. So we'll make that simplifying assumption. What you then need to worry about, let's say you have 2x over collateralization, is like, well, yeah, but what if that backing goes down 75%? Or let's just say, what if that 30 billion in backing for 15 billion in stablecoin, what if that goes down to only being worth 10 billion, which totally could happen with something like ETH. Well, the way that a protocol can solve that is by basically reducing the amount of outstanding stablecoins by doing forced redemptions. Okay, so let's make a simple example here. Let's say that you have, I don't know how to make this simple, but let's say you have 10 billion in stablecoins and you have 20 billion in backing with ETH. And that backing is going down in value. But let's say it's at 20 billion now. If the protocol automatically sort of buys out of circulation 5 billion of stablecoins, so you go from 10 billion in stablecoins down to 5 billion. You've also gone from 20 billion in backing down to 15 billion in backing, right? Because I had to spend 5 billion to redeem 5 billion. Now you'll notice that 15 billion compared to 5 billion, that's 3x. Whereas 20 billion compared to 10 billion, that's 2x. So by forcibly buying back stablecoins out of circulation, as long as you're still over-collateralized, you increase that ratio of over-collateralization. And so the way that Maker and any other protocol like this works is it watches the value of its collateral, and if that value of collateral starts to get lower, then it responds by basically buying stablecoins out of circulation with that collateral in order to readjust that ratio to make sure that the ratio of value of backing collateral doesn't get dangerously low. And so you can see that there's still a way that this could unwind, right? If ETH goes, from its current price to, 1/4 of its current price, just like that, with no warning, just all of a sudden flash crash, then there would be no time for the protocol to unload stablecoins. And so you could go from being over-collateralized to under-collateralized, nearly instantaneously. And at that point, you could get a bank run. And so, the world where DAI ends up experiencing a bank run, or another stablecoin with that design, is a world where we get a really, really fast flash crash. And this would apply also to the mechanism with, on-chain lending, like Compound and Aave and other protocols like that, because they use a similar mechanism here. So it's not that there's no risk. There is some risk there, but as long as you make the assumption that those collateral assets won't flash crash like that, and you can help with that assumption by diversifying your collateral types, then you can design a system that is otherwise, as far as I can tell, relatively safe, or quite safe. And just to like kind of make that clear, it's like I would be very comfortable putting a lot of money in DAI. I'd be very comfortable putting a lot of money in USDC, even USDT. When USDT was going down the other day because of people being concerned, I actually went and bought some USDT and made a little bit of money. Not a lot, but a little bit, because I thought this through and I'm like, yeah, I think it's fine. I think that that's actually just sort of free money to buy at below $1. Whereas with algorithmic stablecoins, I would not do that. I think it's very risky. So I hope that this has helped explain these three different types of stablecoins and how they're very different. And we call them all stablecoins, but maybe we shouldn't. We at least need names for different categories. We at least need conceptual frameworks to understand the difference. And I hope to help with that. The last thing I want to talk about, and if you've watched all the way to here in this video, then I think you'll be interested in hearing these next ideas, is, how could we have prevented what just happened? Like what just happened was like really messed up. Like a lot of innocent people lost money. I've been hearing from our team, we have many team members, a few tens of team members in Argentina. We've been hearing that a lot of normal consumers in Argentina have been heavily marketed UST through apps that make it super simple to just put your money in, kind of like dollars and get this 20% return. For someone who's trying to escape the inflation of the Argentine peso, that's really attractive. And so the rumor, at least, is that, that's at least one population that goes beyond DeFi degens, right? Like it's not just DeFi degens here. We're talking about like we'd started to reach normal consumers. It really sucks that those people have lost money. How do we prevent this? How could we have prevented this, and what should we do to try to prevent this happening in the future? So these are just a few ideas. One is that I really think it makes sense to have some sort of independent body to do stablecoin ratings. I think, people won't necessarily trust me. I'm part of a stablecoin project. People will regard me as biased. But if you imagine that there was maybe a nonprofit organization or at least an independent for-profit company that didn't have equity or exposure, in any stablecoin project, and it, employed economists to do ratings, to study these things and say, this looks really sound, this looks questionable, this looks really risky. You can imagine a CoinMarketCap like website that listed all of the stablecoins. You could rank them by their market cap, where ordinary people could go and quickly see a rating. And if they wanted, they could double click and see a whole lot more information. I think that that's something that would have been useful. That would have been a useful tool in the debate over UST, because there were critics, but there was no obvious source of truth. There was nowhere to point and say, your argument doesn't make sense. Go look at this. This is more sensible than what you're saying. So I think that's one thing that makes sense to do, and I think we should do it. Another idea that's come to mind is, imagine that you are, and so I generally worry about regulation being made that's overgeneralized, that ends up actually hurting the progression of crypto and the useful things that we can do with stablecoins in the world. And I think there's a lot we can do that is actually beneficial to the world with stablecoins. One regulation idea that comes to mind is like, how when you look at like a package of cigarettes in some countries, there's like, pictures of like someone's, lung cancer, exposed, and you're like seeing, the terrible things that cigarettes can do, or just words telling you that smoking kills people, or statistics or whatever. Obviously that doesn't stop people from smoking entirely, but it probably stops some people, and you at least give people the opportunity to make a somewhat more informed choice. Imagine if there was something similar here. So imagine if you download a fintech app, kind of like slick fintech app that gives you the ability to put your money in just dollars, say, or maybe like you deposit your USDC in Compound, or put your money in something like UST. Imagine if there were some sort of simple warning, right? Like, imagine if to put your money in UST, you had to watch a short video or see like a picture of like, a price chart of a coin completely crashing that says like, coins with a similar design have crashed in this way before. Do you still want to do this? Right? It's not perfect, but that kind of is like a sort of just-in-time piece of information that could actually help consumers make that choice. And so this is a possible direction for regulation that I think could be productive. And it's challenging because it would have to be done on a country-by-country basis. Regulation is always tough that way. But I think that when I'm trying to think about what's a productive regulation that we could apply here, I'm worried about regulations that just say, don't make any stablecoins, or even don't make any algorithmic stablecoins, because it's hard to perfectly define that. I think, consumer protection and warnings, though, could be very productive. The third idea is very different from both of those two, which is, and this idea will maybe not make sense to some people depending on your level of familiarity with what a Soros attack is, but a Soros attack is when somebody senses that there's a weak peg in a currency, crypto or fiat, and basically shorts that currency in order to cause it to unwind, in order to profit. And I think that a Soros attack can actually be a healthy thing in the crypto world, because if there are large funds attempting to perform Soros attacks on novel stablecoin designs when they are small, when their use is still confined mostly to explorers and sort of DeFi people who are usually have a higher risk tolerance and know what they're getting into, then that would be a really useful sort of real world test, right? Like if your stablecoin can make it past significant attempts to break the peg all along the way as it's getting bigger, then maybe it's going to work. And if it can't make it past that, and it falls apart, well then great, we learned that when it was small. And so I actually think that this is kind of like an evolutionary market incentive driven approach that would be really healthy. And I'm sure that there are funds out there that have tried to do that in the past, and that might have even have been what happened with UST just now. But I would hope that we could get to them sooner. This was too late in my opinion. I think that if this happens early on in the low number of tens of millions or maybe 100 million or something, it could really cause way less damage than what has just happened. So I circulated this idea. I spoke to someone running a fund about this morning, and I was happy to hear that they and their partners at the fund were already looking into this idea. So I think actually it's not that weird of an idea. Probably many funds are thinking about this now that this just happened. I think by default, we're probably just going to have funds that are more geared towards being able to perform Soros attacks, and that's going to provide a healthy pressure in the crypto ecosystem that I hope will prevent any algorithmic stablecoin getting this big in the future. But if you find that idea interesting, especially if you are a large capital allocator, like you're another crypto project with a big treasury or a fund, feel free to reach out to me and talk about that. I'm interested in coordinating larger pools of capital that have the mandate to perform those attacks, again, because I think it can be a positive thing that actually reduces the harm on net. So those are some ideas for how I think we could have done better. I think we actually should have done things like these in the past, and it's on us that we didn't. And I think we should try to do them in the future. And I'm willing to put our money where our mouth is. So I'm willing to allocate some of our project treasury to paying for these things like this, paying for potentially independent stablecoin review association of some kind or nonprofit of some kind, and hiring people internally to maybe do some of this work. And similarly, I'm interested in allocating some of our project's treasury capital to funds with that mandate, who are willing and able to deploy the funds in that way to try to protect ultimately the end user of novel stablecoins. So if you watch this video all the way through and you're interested in working on this kind of thing, trying to actually fix some of these mistakes and try to prevent future harms, especially if you are highly skilled or highly experienced. If you're an experienced trader, or you are an economist who'd be interested in working on that, or if you're an organizer type, if you would want to be like sort of the CEO of, or not sort of, but the CEO of a project of this type, let me know. This is something that I'm interested in meeting people and coordinating efforts to try to do better in the future. So in closing, we really messed this up. It's not okay. If we don't find ways of doing better, then more people could get hurt. If we don't find ways of controlling these things ourselves, I do worry that uninformed regulators could make rules that are net harmful to the ecosystem. And we need to be willing to push back even in the face of religious level belief, right? This is something where, if you had said even 2 weeks ago that, the UST peg was going to break or might break, you would just get completely mobbed by LUNA holders who want LUNA to go up. They want more people to buy LUNA. And so they want everyone to believe. And that just happens to every crypto project. You get believers who will come and tell you to, they'll say all sorts of mean things if you say something negative. So I think we let ourselves as an industry succumb to that pressure in the case of Terra. And we sort of let the reality distortion field get too big and go on too long. And so I hope that we can find ways. It's essential that we find ways of not doing that in the future. And so again, please reach out if you want to help me do that.